Gold isn't calming down into month end. Gold is tightening, and the people trying to frame this as a tired blow-off top are missing the one signal that actually runs the show. The headline wants you staring at spot prints and Twitter candles. The real story is hiding in the way the market is pricing time financing and delivery. And if you understand that hidden mechanism, you'll know exactly what to watch over the next week, what level matters, and what breaks if this move is real. Because here's the conflict. On the surface, gold looks like it did the classic thing: rip to a record, wobble, scare late buyers, and hand the microphone back to the dollar narrative. Neat, clean, convenient. And yet the market keeps refusing to actually unwind in the way a true top unwinds. That's not sentiment, that's structure. And structure is where the pressure starts. Let's anchor the context without getting hypnotized by it. In the last couple of weeks, gold pushed to fresh all-time highs in the mid-4500s. And then you saw a sharp pullback on a margin shock story. CME changed precious metals margin settings, and the tape reacted the way it always reacts when leverage gets its collar yanked. Then, almost immediately, gold steadied and rebounded back toward the mid-4400s. And now, right as we're walking into month end, you've got reports of gold printing near another record around $4,690 an ounce in the middle of a fresh geopolitical tariff flare-up narrative. That sequence matters, not because up equals good, but because of what it reveals. When leverage is forced to reduce, a fragile market breaks. A tight market absorbs and keeps walking. And that's not the part most people are focusing on. Now here's the hidden detail I promised, the one that reframes the entire setup. When gold is truly comfortable, time is cheap. When gold tightens, time starts costing money. In a normal market, futures trade above spot because storage isn't free and financing isn't free. That premium is the cost of carry, and it's basically the market saying, no problem, take delivery later, we'll pay you to wait. But when you start seeing the curve flatten in a way that doesn't T-match the everything is fine narrative, or you see signals that the market is paying up for immediacy, you're looking at a market that's quietly telling you something. Paper supply might be abundant, but usable, deliverable, financeable metal is not as frictionless as the headlines imply. And that's where it gets fun, because once you see it, you can't unsee it. Most retail investors are trained to treat gold like a mood ring. Dollar up, gold down, real yields up, gold down, risk off, gold up. That's the kindergarten version. It's not wrong, it's just incomplete, because gold is also a market structure product. It's a derivatives market with financing, vaulting categories, delivery rules, and a global physical flow layer sitting underneath it like a slow-moving undertow. And in 2026, that undertow has been doing something very specific. Central banks have been buying gold at a pace that changes the shape of the whole system. Let's talk about that returns part in your title, because it's not a vibe, it's a demand function. When a central bank buys, it's not chasing a weekly candle. It's not taking profit because RSI is hot. It buys because it is adjusting reserves, hedging political risk, diversifying away from concentration, or matching long-term policy constraints. It's the definition of inelastic demand. And when inelastic demand shows up in a market where a ton of supply is technically above ground but not necessarily floating freely at the margin, the price doesn't just rise, it tightens. World Gold Council data has central banks buying over 1,000 tons for multiple years running, including 1,045 tons in 2024. That's not a random anecdote. That's a structural bid. And it wasn't just one country doing a one-off purchase. The buying has been broad across emerging markets with visible repeat buyers. Meanwhile, through 2025, official sector demand remained elevated quarter after quarter, even when the pace varied, and on top of that, you had periods of heavy ETF buying and strong bar and coin demand. Put those layers together and you get something that matters more than any single CPI print. A persistent buyer base that doesn't care about the same triggers that typically end a rally. Now, the skeptical crowd will say, sure, central banks buy, but price already moved. So what? Here as the so what. Central bank buying doesn't need to be the thing that spikes price tomorrow. It needs to be the thing that quietly removes float, tightens financing conditions at the margin, and forces other players to behave differently. And when those other players are leveraged futures traders, bullion banks managing inventory, or dealers hedging options exposure, behaving differently is exactly how squeezes and air pockets happen. Let's hit the CME margin change, because it's not just a footnote, it's a mechanical amplifier. CME moved precious metals margins toward a methodology that scales with contract value, and the timing lined up with extreme volatility. The market heard one message: collateral costs are rising exactly when price is rising. If you're long with leverage, you need more cash. If you're short, you need more cash. Either way, the system demands liquidity at the worst possible time. That's not a moral judgment, it's plumbing. Plumbing decides outcomes when everyone is leaning. Here's the micro detail people miss. A margin shock can be both bearish and bullish, depending on what kind of market you are in. In a weak, frothy market, margin hikes trigger cascading liquidation and the bid disappears. In a tight market, margin hikes flush weak hands, but don't create fresh metal. They force covering, they force hedging, they force a repricing of risk, and that's why you get violent dips that don't follow through, followed by a market that tightens even more. Because the cheap, over-leveraged supply got removed, and the remaining holders are the ones least sensitive to noise. And that's not the part that matters most. The part that matters most is the calendar. Month end isn't a meme, it's a constraint. Dealers manage balance sheets, funds rebalance. Volatility targeting strategies adjust exposure. Options books get cleaned up, futures get rolled. And in metals, the delivery calendar sits in the background like a quiet threat. You don't need a conspiracy for this to matter. You just need incentives. If liquidity is thinner into month end and large players have to do things on schedule, small stresses turn into outsized moves. That's why the right now time frame is so important. This is exactly when markets reveal whether a move is real, because real moves survive forced flows. So let's map the setup into something you can actually use. Price, structure, flows, and the lie detector signals. Start with price structure. When gold runs into a record zone and then pulls back, you want to see whether it bleeds or it snaps. Bleeding is distribution, lower highs, lazy rebounds, sellers showing up earlier each time. Snapping is tightness, fast dips, fast bids, and an unwillingness to spend time below prior breakout areas. The psychology here is brutal. A fast dip triggers panic. A fast rebound triggers regret. That cycle is how the market harvests emotional liquidity. And if you're not ready for it, you become the liquidity, because that's exactly where the real pressure starts. Now, let's translate that into levels without pretending we're drawing perfect lines. In this regime, the first thing you watch is whether gold holds above the most recent panic low created by the margin shock. If price can't reclaim and hold above that, you're in a broader cooling phase. If it holds and builds, the market is telling you the sell-off was about leverage, not fundamentals. Then you watch the record zone. Records aren't just numbers, they're psychological collateral calls. When the market approaches a record again, shorts get anxious, longs get greedy, and liquidity thins. That's where gaps are born. But that's not the part that matters. The next detail is what flips the whole setup, the options layer. Even if you don't trade options, options trade you. Because dealers who sell options hedge their exposure dynamically, and that hedging can push price around in ways that look like mystery momentum. Well, if a bunch of call options pile up near round numbers into expiry or month end, dealers may need to buy futures as price rises to stay hedged. That's delta hedging. If the market moves into a region where the dealer MS hedging sensitivity spikes, positive gamma versus negative gamma regions, you can get reflexive moves. Up moves force buying, down moves force selling. That's why you'll see days that feel like the market is possessed. It's not possessed, it's math. Now add the positioning layer. The CFTC's Commitments of Traders report gives you a window into speculative net positioning, and recent releases show speculators holding sizable net long exposure. One widely circulated read has non-commercial net longs north of 250K contracts in mid-January. That's not a prediction, it's a volatility clue. A heavy net long can mean the market is crowded and vulnerable to shakeouts, but it also means there's a lot of risk that can't just vanish gracefully. If price rips higher into thin liquidity, shorts can get trapped quickly. If price dips hard, late longs get margin called. Either way, the path gets weaponized, and that is exactly why month end is dangerous. So what's the actual Titans thesis here? It's not gold goes up forever. It's that multiple layers are pointing to constrained elasticity in the system. Official sector accumulation, periodic investor inflows, volatility-driven collateral dynamics, and a calendar window that forces transactions at precisely the wrong time. When you have that kind of setup, you don't need a perfect macro backdrop. You just need one more stressor, one more headline, one more funding hiccup, one more currency tremor, one more geopolitical escalation, and the market does the thing it does when it S-tight. It jumps. And yes, that includes the geopolitical layer you're seeing right now. Tariff shocks, trade war threats, political brinkmanship. These are classic accelerants for safe haven demand. But the key is that they don't create the bid from scratch. They activate it. The bid was already there. The story just gives it permission to show up on the tape. Now, I want to talk about the paper versus physical tension without sliding into cartoonish claims, because this is where a lot of people lose credibility. The real, finance-literate way to discuss it is incentives and signals. Physical markets clear differently than futures markets. Futures are a financing and hedging ecosystem. Physical is procurement and allocation. When the physical side tightens, you might see it as changes in regional premiums, shifts between benchmarks like Shanghai and London, or tug of war in lease rates and time spreads that indicate immediate metal is valued differently than future metal. You don't need to claim a shadow cabal. You just need to observe that different pools of demand express differently, and the arbitrage between them is what pulls the global price magnet. Think about it like this. If demand is strongest in one region, and that region is bidding up physical metal, arbitrageurs try to move metal there. But moving metal isn't instantaneous. It has logistics, refining specs, vault constraints, and sometimes policy frictions. That's where the real pressure starts. Because if metal can't flow freely at the exact pace demand wants, the market's adjustment mechanism becomes price and spreads, not more supply. You can't mine faster next week just because the chart is vertical. And recycling doesn't tee us to respond like a light switch either. People don't tee instantly melt down jewelry because your favorite influencer posted a bullish thread. Now, zoom out to the institutional flow layer. The West often watches ETFs as if they're the whole story. ETFs matter, especially when inflows are large. World Gold Council data showed huge ETF buying in parts of 22-25 and robust investment demand alongside sustained central bank activity. But here's the nuance. ETFs can amplify moves, but they are not always the origin of moves. They are the crowd arriving late with a megaphone. The origin is often the slow, policy-driven bid that doesn't post on social media. And when those two line up, official sector accumulation plus investor inflows, you get a market that doesn't just trend, it tightens. So what does tighten mean in practice for your next week or two? It means the market punishes complacency. It means pullbacks can be shallow and violent at the same time. It means you can have a day where gold drops hard, feels like the end of the world, and then rips back in your face. It means your timeline gets stressed. If you're positioned with too much leverage, the market doesn't need to be wrong to wipe you out. It just needs to swing. And that's why the psychology shield matters more than the price target. Here's the psychology shield, and I want you to actually use it, not nod at it. In tight markets, volatility is a weapon, not a moral weapon, an incentive weapon. If you can shake out weak holders, you reduce supply and clear the path. The market will bait you with certainty, then punish you with noise. It will convince you that one red candle invalidates the thesis, then it will punish you again when you chase the rebound. Your job is to separate trend signal from path noise. Trend signal is the market holding key structural zones, maintaining demand on dips and showing stress in the right places like spreads, financing, and how quickly bids appear. Noise is intraday whips, headline-driven spikes, and the emotional stories people attach to every tick. And here is the part nobody wants to hear. You can be right on direction and still lose money if your risk is wrong. That's not fear-mongering, that's just markets. Now let's get concrete with the what to watch next checklist. Because this is where you either build trust with yourself or you get dragged by vibes. First, watch how gold behaves around the most recent breakout and retest region. Does it spend time below it, or does it reject that area quickly? Tight markets reject quickly. Second, watch the reaction to margin and volatility narratives. If another volatility spike hits and gold refuses to cascade, that's strength. Third, watch positioning optics. If speculative net longs are high, expect shakeouts, but also respect the possibility of forced short covering if price makes new highs into thin liquidity. Fourth, watch the physical signal layer in whatever way you can access it. Regional premium chatter, benchmark divergences, delivery talk, and any hints that immediate metal is being valued differently than deferred metal. You don't need perfect data. You need to see whether the tightness story is being confirmed by behavior. Now, the counterpoint, because you need it, because pretending it doesn't exist, is how people get wrecked. Gold can absolutely cool off into month end. It can do the annoying thing, chop sideways, drain momentum, and frustrate everyone. It can also do the nasty thing, a deeper pullback if the dollar spikes, if real rate expectations jump, or if risk assets stabilize and the market decides to delever across the board. And if central bank buying slows for a period, that can reduce the background bid. None of those invalidate the long-term structural story, but they can change the short-term path. And in the short term, the path is everything. So here's your two-scenario lens. Simple, clean, usable. Scenario 1 is the controlled pullback and retest. Gold dips, shakes out late longs, tags a prior support zone, and then builds a base. This scenario is messy but constructive. You'll see lower intraday lows, but you won't see sustained acceptance below key structural levels. Volatility stays elevated, but the market keeps finding buyers. In this world, your edge is patience and risk control. You're not chasing green candles, you're watching for the market to prove it can hold. Scenario 2 is the continuation squeeze. Gold holds tight, reclaims records, and pushes into price discovery with liquidity thinning. This scenario is where gaps happen, where headlines scramble to catch up. and where people who waited for a pullback suddenly capitulate at the worst time. In this world, the risk isn't T being wrong, it's being underprepared for how fast it can move and how violently it can whip back. Because if this one level breaks, if gold starts holding above the prior record zone rather than just tagging it, the math changes. Dealers hedge differently, shorts behave differently, and the market can shift from trend to event overnight. Notice what I'm not doing here. I'm not promising you a guaranteed number. I'm not pretending we can know the next candle. I'm giving you a framework that respects the reality of a tight market, probability, incentives, and risk. Now, let's tie the title together. Central bank buying returns, gold tightens into month end. The returns part is really about persistence and visibility. Central bank accumulation has been a multi-year feature, but what changes in moments like this is the market's sensitivity to it. And when gold is boring, the official bid is background music. When gold is tight, the official bid becomes the bass drop that everybody suddenly feels in their chest. Not because they discovered a new statistic, but because the system is already stretched. Financing, positioning, calendar, liquidity, and the bid removes the cushion. And that's why the mainstream misses it. Mainstream coverage wants a single cause. It wants tariffs made gold go up, or margin hikes made gold go down. Reality is layered. Mechanism plus flow, plus constraint, plus calendar. That's the whole game. So what do you do with that as a finance-minded retail investor who doesn't want to get emotionally farmed? You stop trying to predict. You start trying to observe. You watch whether dips are bought with urgency or with hesitation. You watch whether new highs get rejected violently or accepted calmly. You watch the behavior around month end. Do forced flows create temporary dips that get absorbed, or do they trigger cascading weakness? And you respect that volatility can be used against you even when the thesis is correct. One more thing before we close, because this is a trap people fall into every cycle. Don T confuse tight market connote with Kyoto straight line. Oh, the tight markets are not smooth. They are jagged. They run stops. They create narrative whiplash. They make you feel stupid twice a week. That's not a bug. That's the feature. The market doesn't need you to be wrong. It needs you to be emotional. So as we head into month end, here's your near-term roadmap in plain language. If gold holds its recent structural floor and keeps snapping back on dips, you treat weakness as part of the tightening process, not as instant invalidation. If gold loses that floor and starts spending time below it, real time, not a 5-minute wick, then you're in a cooling phase and the market is telling you it needs to reset before it can run again. If gold reclaims and holds above the prior record zone, you prepare for the squeeze scenario and the gap risk that comes with it. You don't need to bet the farm. You need to be ready for the path. And if you want a subtle edge, here it is. Pay less attention to the loudest headline and more attention to the market, S reaction to it. Tight markets shrug off bad news and accelerate on good news. Weak markets do the opposite. That reaction function is your tell. Because the price is always trying to lie to you, but the structure is forced to tell the truth. If you're still here, you're already in the minority, the group that cares about mechanisms, not vibes. Stick with that. Keep it analytical. Keep it calm. And as month end forces the big players to show their hand, you'll be watching the right things while everyone else argues about yesterday's candle.